Silver just did something terrifying. In only 1 week, the price of silver dropped significantly. It fell by 40%. It went from a very high price of $122 all the way down to $71 in what felt like one night. Then it jumped back up very quickly. Right now, every person who buys or sells silver is asking the same big question. Was that the lowest price we will see, or is the price just jumping up a little before it falls even further? If you look at the charts, they cannot tell you the future for sure. No one has a magic ball that shows what will happen tomorrow, but the charts can show us what is likely to happen. There is a big difference between being sure about something and knowing what is likely. If you understand this difference, you will be a smart trader. If you do not understand it, you are just playing a game of luck, like flipping a coin. This is the 7th and the very last video in our series about why silver and gold prices crashed. In the first 6 videos, we talked about how the market is built. We talked about the big banks and the rules they have to follow. We talked about how people borrow money to buy silver and what happens when they have to pay it back fast. All of those videos were about the big parts of the money world. This video is different. Today, we are going to look at technical analysis. This is a fancy way of saying we are looking at pictures of the price. We want to see what the charts tell us about where silver might go next. But before we look at the numbers and the lines, I need to tell you what this really is. Many people get this wrong. Technical analysis is not a way to tell the future. It is not a magic trick. It does not say that the price must go to a certain spot. Instead, it is like a map of what might happen. It uses things that happened in the past to guess what might happen now. It looks at levels where the price stopped falling before. These are called support levels. It looks at levels where the price stopped rising before. These are called resistance levels. It shows us how people behave when they are trading. But here is the most important part. It does not promise anything. Markets can break through any level. They can do things that no one expected. So when we look at these charts today, we are not saying we know the future. We are just finding important spots to watch. We are looking at different paths the price could take. We are trying to understand how people feel when they see the price move. This is because charts are really just a picture of how humans act. This is very important. If you think charts tell the future, you will make bad choices. If you think charts show you what is likely, they become a very good tool. This channel is for people who want to learn how to think about the market. We do not give guesses about the future. If you like learning how to think clearly, you should subscribe. Now let's start with our first tool. It has a long name called Fibonacci retracement. I want to explain what this is and why it works. If you know why it works, you will use it better. This tool is based on a set of numbers found by a man from Italy a long time ago. He lived in the year 1200. These numbers are very special. You can find them everywhere in nature. You can see them in the way a shell spirals. You can see them in the way trees grow branches. You can see them in the petals of a flower. You can even see them in the shape of the human body. Why does this matter for silver? Well, if these numbers are in nature and humans are part of nature, then these numbers might show up in how humans make choices. This includes choices about money. I am not saying it is magic. I am saying that these specific levels, like 38%, 50%, and 61%, show up a lot when prices fall. They show up because so many people are looking at them. It becomes a thing that happens because everyone thinks it will happen. To use this tool, you find a low price and a high price. You draw a line between them. Then you look at where the price might drop to. These spots are where the price might stop falling. It is not because of magic, but because of how people have acted for hundreds of years. Let's look at silver now. If we look at the low price in April of 2022, silver was at $28. Then it went all the way up to $122 in January. If we use our special tool, the 50% level is right at $71. That is exactly where silver stopped falling the other night. That is not just a lucky guess. It is the market finding a spot where people have always wanted to buy in the past. Now, does this mean $71 will always hold? No. These levels can break, but it means $71 is a very important spot to watch. If the price stays above $71, it might mean the crash is over. If the price falls below $71, it could go much lower. It might go down to $50. That is where the price was a long time ago, in 1979 and 2011. This is how you use the charts. You map out what could happen. Most people think they are supposed to guess where the price will go. That is not right. You should be mapping out the paths. Being a good trader means knowing the difference between a guess and a plan. Think about it this way. When you see a spot on the chart at $71, you are not saying the price will definitely stay there. You are saying that based on history, that spot is where people usually buy. So there's a good chance it will stay there. But a good chance is not a promise. If there is a 70% chance of something happening, there is still a 30% chance it will not happen. If you act like the 70% chance is a promise, you will lose a lot of money. So, how do you use this the right way? You look at 2 or 3 different things that could happen. You find the important numbers for each path. Then you watch the price to see which path it is taking. For silver right now, there are two main paths. Path number one is the happy path. In this path, the $71 price holds. If it stays there, silver might go back up to $90 or $100 soon. It won't go straight back to the top. It will take time to get strong again. This is what we call the bullish path. Path number two is the sad path. In this path, the price falls below $71. If that happens, there is not much to stop it from falling a long way. It could go down to $50. This is what we call the bearish path. Both paths could happen. No one knows which one will be the winner. Your job is not to guess. Your job is to watch and see which path the price picks. If it stays at $71 and starts to look strong, it is picking path one. If it falls below $71 with a lot of selling, it is picking path two. This is how you should use charts. This is what we teach on this channel. If you want more lessons like this, please subscribe. Now let's talk more about how to find these floor levels. We call them support levels. A support level is a place where many people want to buy. It is a place where there are more buyers than sellers. You find these by looking at the chart for spots where the price bounced many times. If a price hits a spot and goes up and then does it again, that spot is a floor. For silver, if you look at the end of last year, the price stayed between $90 and $95 for a while. It hit $90 and went up many times. That made $90 a strong floor. But something happens when the price falls through the floor. The old floor becomes a new ceiling. We call this resistance. Why does this happen? Think about the people who bought silver at $90. Now the price is at $75. Those people are losing money. They are sad and worried. They tell themselves, if the price ever goes back to $90, I will sell it so I can get my money back and not lose anything. When many people think this way, it creates a lot of sales at $90. So if silver tries to go back up, it will hit that ceiling of people wanting to sell. This is not magic. It is just how people feel. It is human behavior shown on a chart. Now let's talk about how people feel as a group. We call this sentiment. This is one of the best ways to know when a big change is coming. Sentiment is just the mood of the market. Are people happy? Are they scared? Are they excited? The trick is to look for when everyone feels the same way. When everyone is super excited and thinks the price will never stop going up, that is usually when it is about to fall. Why? Because if everyone is already excited and has already bought silver, there is no one left to buy more. And if no one is left to buy, the price cannot go up. When people start saying things like, this time is different, or the price will go to the moon, you should be very careful. On the other side, when everyone is very sad and scared, that is often the best time to look at buying. When people say, I will never buy silver again, or this was a trick, it usually means everyone who wanted to sell has already sold. If there is no one left to sell, the price cannot go down anymore. Before silver hit $122, everyone was very happy. People on the internet were saying it was a super cycle. They said there was not enough silver in the whole world. They said the price would keep going up forever. That was the sign that the top was near. And then the price crashed. Does this mean these feelings always tell the truth? No. Sometimes people can stay happy for a long time, but it is a very good tool to use. It tells you when too many people are all doing the same thing. Not all price moves are the same. Some moves happen for good reasons. Maybe companies need more silver to build things. Maybe there is a war or big news. These are called rational moves. But some moves happen just because people are emotional. They happen because people are afraid of missing out. We call this FOMO. Emotional moves look like a straight line going up. They happen very fast. But they cannot last. They are like a balloon that gets too much air. Eventually, it has to pop. This is because emotional moves are not based on real reasons. They are based on feelings, and feelings can change in 1 minute. When an emotional move pops, the price usually falls very far. It often falls past where it started. This is because the same fear that made people buy now makes them sell. They are afraid of losing all their money. If we look at silver, the move from $20 up to $90 was slow and steady. It was a rational move. It made sense. But the move from $90 to $122 was very fast. That was the emotional part. That was the FOMO part. So when the price crashed, it made sense that it wanted to go back to $90. That is where the rational move ended. Silver actually fell even further to $71 because people were so scared. Understanding the difference between a rational move and an emotional move is a very big skill. It helps you see where the real floor is. Now let's look at what might happen next. Even if the $71 floor holds, it does not mean the price will zoom back to the top. There are two groups of people right now. The first group is the people who didn't buy silver when it was expensive. Now they see it is cheaper and they want to buy it. This creates buying pressure. This is why the price bounced. But there is a second group. These are the people who bought at the very top. They are down 40%. They are very scared. They just want their money back. They are waiting for the price to go up a little bit so they can sell and get out. This creates selling pressure. When these two groups fight, the price usually goes sideways for a long time. It goes up a little, then hits the sellers and goes down. This is why things do not usually recover in a V shape. It takes a long time to build a new base. It takes time for the scared people to leave and for new, calm people to take their place. You must be patient. One of the biggest mistakes people make is not about being right or wrong. It is about time. You can be right about where the price is going, but if you get the time wrong, you can still lose all your money. Many traders lose money because they are too early. They see a good trade, but they use too much borrowed money. We call this leverage. If you borrow a lot of money to buy silver and the price drops even a little bit, you might be forced to sell. Even if you were right and the price goes up later, you are already out of the game. The market does not care about your schedule. It moves when it wants to move. If you think silver is going to $150, you might be right. But if it takes a year to get there and you used too much borrowed money, you might not last that long. The secret is to use only the money you have. If you do not use leverage, you can wait as long as you need to. Time becomes your friend. But if you borrow too much, time is your enemy. You are racing against the clock. This is a lesson for all markets, not just silver. Being patient and having the right size of trade is more important than being a genius. I made this video because I want you to see charts in a new way. Do not look at them as a way to tell the future. Look at them as a way to see what is likely. Look at them to see how people are feeling. Look at them to find the important floors and ceilings. This helps you make a plan that works, even if you are wrong. That is what we do here. We give you a way to think. We do not give you a crystal ball. If this video helped you, please share it with a friend. Share it with anyone who likes to trade. The difference between guessing and planning is the difference between losing money and learning. Please subscribe if you have not done that yet. We do not use hype or big promises. We just look at how things work. The next big move in the market will happen. It might be up or it might be down. People who understand that charts are about chances will be ready. People who think they know the future will be surprised. Keep learning, think about the chances, and always do your own homework. Now, I have to say something important. This video is just for learning. I am not a financial advisor. Looking at charts is hard, and markets can do anything. Just because something happened in the past does not mean it will happen again. Anytime you put money in the market, there is a risk you could lose it. You must do your own research before you buy or sell anything. I am not telling you what to do with your money. I am just teaching you how to look at the numbers. Be safe and think clearly.